In this video, I want to highlight why discipline is important in managing short-term market movements. Discipline is very, very important when it comes to management of the inherent short-term market movements. Managing short-term market movements can be challenging due to volatility, but maintaining a disciplined approach is key to successful investing. A disciplined strategy allow investors to stay focused on their long-term goals and objectives and avoid reacting impulsively to market fluctuations. We want to look at this particular topic under a number of subheadings. Number one is reduces emotional decision making. Reduces emotional decision making. And in this aspect, we want to talk about preventing panic selling. Preventing panic selling. So a disciplined approach helps investors to resist the urge to sell in a panic during market downturn. So instead of reacting emotionally to short-term losses, disciplined investors stick to their plan and avoid making decisions based on fear. The next item is avoidance of over exuberance. Avoidance of over exuberance. And so conversely, during market rallies, a disciplined investor avoids getting caught up in the excitement and in the euphoria and making impulsive buys, driven by greed or fear of missing out. So once you remain disciplined, you will avoid panic selling, and you will also avoid the tendency to indulge in over-exuberance. Number two is focuses on long-term goals. Focuses on long-term goals. So in this case, you stay aligned with your objectives. Staying aligned with objectives. A disciplined approach help investors keep their eyes on the long-term goals, such as retirement or saving for a major purchase, instead of being distracted by short-term market noise. This focus reduces the likelihood of making trades that go against the investor's long-term financial plan. We also want to consider minimizing distractions. Short-term market movement can often seem dramatic, but staying, disciplined means we don't allow, these fluctuations to distract, us from the bigger picture and the reason we started investing in the first place. The market is full of fluctuations here and there, noise here and there. But once you remain focused on your long-term objectives, you don't easily get distracted. Number three is helps avoid market timing. Discipline helps to avoid market timing. So we want to consider ineffectiveness of timing, the ineffectiveness of market timing. And so attempting to time the market, especially in the short term, is difficult and often known to be ineffective. Nobody can do it accurately over time. And so a disciplined approach focuses on consistent investing rather than trying to predict market movements. This avoids the trap of buying high and selling low. Just, execute your trades based on the fundamentals of the company. Forget about the issue of trying to time the market or trying to predict market movements. I don't really think it's necessary. So we also consider, dollar cost averaging. So instead of buying at the perfect moments, which might not really, come. The issue is that you set aside a certain amount of money you invest regularly. It might be monthly, it might be quarterly, it might be biannually. So You just do that regularly. That particular action is called dollar cost averages. Averaging. When the market is a bit high, you buy. When it is low, you buy. You discover that at the end of the day, you would have an average price all through. You have you buy at a price that is considered low. You buy at a low price overall. Number 4 is encourages consistent monitoring and adjustment. Discipline encourages consistent monitoring and adjustment. So in this case, you consider regular review. You review your portfolio regularly. So a disciplined investor routinely review their portfolio and adjust it based on changing life circumstances, risk tolerance, and financial goals, rather than reacting to every short-term market movements. So you rebalance your portfolio, you review your portfolio based on your long-term objectives, not based on the noise that is inherent in the markets. And not only that, you rebalance your portfolio, you sell more of what you need to sell, and you buy more of what you need to buy, considering your long-term investment goal in mind. You may sell overpriced assets, you buy undervalued ones, and that's a form of rebalancing. Please don't forget to like this video and subscribe to this channel if you've not done that, so I can be encouraged to keep on bringing contents of this nature to you. Number 5 is help mitigate risk. Discipline helps in mitigating risk. And so we look at risk management. A disciplined approach includes maintaining proper diversification, which help to manage risk and prevent heavy losses in any single asset during market fluctuation. Once you are fully diversified, a loss sustained in a single asset, will not affect the entire portfolio. You equally consider position sizing. So disciplined investors determine how much of their portfolio to allocate to each asset class, preventing large exposure to high risk investment, which can lead to significant losses during volatile periods. So you sit down and critically think and come up with a plan on how to allocate a portion of your capital to each assets based on the level of your level of risk tolerance. Number 6 is discipline instills patience. It instills patience. So in this case, you discover that patience in a volatile market is very, very important. Market corrections, downturns or sudden spikes are common, but a disciplined approach encourages patience. Once you are disciplined, you'll be able to stay and remain patient during this inherent market volatility. So investors with patience avoid making rash decisions in response to short-term volatility, allowing their investment to recover and grow over time. So you stay patient. You're not ruffled. You don't panic. And so discipline equally kind of encourage compounding by staying invested over the long term. Disciplined investors take advantage of compounding, which can significantly enhance returns even during times of market fluctuation. So if you are disciplined and you stay invested despite market noise and fluctuation and volatility, you will at the end of the day discover that your portfolio will yield the kind of returns you expect to get. Number 7 is enhances confidence. Discipline enhances confidence. So you discover that discipline will help you to follow a plan, following a plan. So when investors, follow a disciplined strategy, they have confidence that their decisions are based on sound principles, not emotional reaction, not based on fear or greed. So this confidence helps them stay calm during market turbulence and trust their investment processes. And then only that, you also look at the fact that discipline reduces stress. It reduces reducing stress. And by sticking to a well thought out investment plan, investors can reduce the stress that comes, with trying to manage short term movements and stay focused on their long term financial objectives. So, in conclusion, a disciplined approach to manage short-term market movement is essential for long-term success. By focusing on long-term goals and avoiding emotional decisions and sticking to a well-defined strategy, investors can reduce the impacts of market volatility and achieve more consistent returns over time.